right, everyone. Welcome to this weekly or bi-weekly update from Gentian. We enjoy seeing you. We look forward to talking to you, and thank you for being on with us today. So on behalf of our entire team, we really like to say hello and thank you. I think actually you might have a picture of us. Why don't we all wave? You put us in the view. We wanted to show you that we're all here. Maybe, is there a different view here? I think that we can see us all. Gallery view. How about that? You can see everybody now? So hello to everyone on our team. There you go. Julie's out helping her mother right now, so we have one member who's not there. And Mike is sitting absolutely still, which is pretty impressive. So thank you very much. Well, I'm going to kick it off by heading it over to housekeeping right away, and then we'll go big. So if we might have Ashley begin with us.
Hello, thank you, Chris. And I hope you all saw the latest Gentian monthly bulletin. That should have been in your emails on Monday, but I just wanted to touch on a few important dates. So to get started, yesterday was the final day to RSVP for our International Women's Group, which will be held on Monday, March the 8th. We would love for you to attend. Unfortunately, we just can't get you one of the pieces that we'll be touching on, but again, we welcome you to join us either way, and we look forward to some great discussion with you all in regards to some history on where women have come over many decades of time. Our second big event for next week is Wednesday, March the 10th. And hopefully you've all seen this in regards to our health and wealth series is going to continue. This will be again next week, Wednesday, March the 10th, and we will focus on Nutrition 101. Not your grandma's nutrition lesson. So we look forward to our guest speaker and having her touch on some of the important aspects that we can all do for our health. So don't forget to register. Again, the bulletin takes you directly to a link, and we look forward to seeing you again at 11 a.m. Central Time. Next week, Thursday, is also Ken Flannery right here at our offices, 5th year at Gentian. So we look forward to celebrating his anniversary next week. Don't forget next week's yay! Next week, Sunday, March the 14th, is daylight savings time. Unless, of course, you're in Arizona or I believe Hawaii are the two states that don't. Just also a good reminder to check those smoke detectors. I know that's always kind of a good time to check out those things. And then also something that's new, you may or may not have seen something on our social post, but we are co-sponsoring with Gathering on the Green, a traditions event for our community. So it's actually National Pie Day. Yes, 3.14. I don't remember the rest of it, but yes.
1527. I don't know it either. Sorry.
National Pie Day on Sunday, that same day, March the 14th. We welcome you to stop by the Mequon Public Market. Again, also in your bulletin is the address for that if you have not visited the public market. But we welcome you to come out for this open community event. It is co-sponsored by, again, Gentian, and there will be some great art on display, as well as a musical performance and some snacks available. So a couple of our team members will be there to say hello. So please, we welcome you to stop in and check it out. And then, of course, our next bi-weekly webinar will be on St. Patrick's Day, which is actually Wednesday, March the 17th. So we look forward to seeing you all then. And now I'm going to turn it over to Peter real quick, and he will touch on one other housekeeping item.
Thank you, Ashley. Now that it's tax season, we wanted to give one more reminder. If you made a qualified charitable distribution during 2020, we did send out a letter and posted one to your vault with the details, and I will go ahead and share the example of that. This is what that letter would look like from us. And then secondly, on the Raymond James 1099 that you receive, in the beginning pages, they also do call out the details on your QCD, even though the total gross distribution amount will not remove that. That is going to be required for you or your CPA to do. If you have any questions regarding any of this or anything else, as always, please don't hesitate to reach out to the office, and one of us is more than happy to assist you or send any information out that you may need. That's all for me, so I will go ahead and send it back to Chris.
Outstanding, Peter and Ashley, thank you tremendously for keeping us in order. They are phenomenal at that, and I appreciate it. So part of my gratitude is actually for our team setting this up, and especially with the housekeeping as well. It's fantastic. We have a lot of events going on. We want to make sure that you know what they are and how they work and when they are as well. So thank you as well. Gratitude for us, I'll go big today in a short time because I'm grateful we have a lot to get to. But for myself, I'm grateful for family vaccines in spring. Those are the three things right now. I'll save some of the stories as we got a lot to get to. But how about yourself, Ken or Zach?
Yeah, thank you, Chris. I'm grateful to, first of all, be here with all of you. It's good to see and good to hear everybody and good to be with you all. I'm grateful for the Mequon Thiensville Educational Foundation. There's an event coming up this weekend. They do a great job raising money to really help our school system. And I'm just grateful for all the teachers and educators that are out there. If you're one of them, you probably have one of the most important jobs because all of you probably have one of your favorite teachers that have had a massive impact on you, much like I have as well. And so my gratitude, my heart goes out to all the teachers right now and educators that are out there.
Thank you, Ken. Zach.
This is the first time I've ever been grateful for it, but I'm grateful for the 2 weeks of extreme cold we had. First time I've ever said that being a Wisconsinite for my entire life, but it makes days like we had the 40-degree day last weekend, again today, that much better. So just appreciating the smaller things and things that I used to not enjoy at all because they make some other days much, much better.
Awesome. Thank you, guys. And your gratitude as well. Thank you all for those who share it with us. If you'd like to share it on the chat, please feel free to share what you're grateful for, and we'll definitely see that as we go along. But I like to always start with something funny. So I do like to start with this is, what season it when, sorry, let me start this again. What season is it when you're on a trampoline? Springtime. I know I'm not funny, but for some little kids, they're really going to enjoy that. So use that as something for you. They may get it before you, but more importantly, I know we've got a lot of gardeners out there. People are really getting excited to put their plants in the ground. So what did the overly excited gardener do when spring arrived? He wet his plants. So at any rate, I just want to go through with a couple of those because those are kind of funny. I know that my wife is cringing right now if she's listening to that, but I think it's kind of a vital part of our day. So a couple of things. So Ryan Carroll, a great member of our team, just this week gave us a reminder. I want to actually share this study with you. And it's interesting because do you feel that you're lucky or unlucky? Think about that. Do you feel you're lucky or unlucky? The reason I ask that is because this study once showed people who described themselves as lucky were compared to those who believed they were unlucky. The setup, people were split up into two groups, lucky and unlucky, however you consider yourself, and a cafe was set up, filled with actors, and there were a $20 bill was placed in plain sight on the ground. One by one, the study participants brought them in for a cup of coffee to see who would notice. You want to know what's interesting? Results. Around 80% of those who self-identified as lucky noticed the money laying on the ground. The unlucky people, not a single one noticed the $20 bills laying at their feet. Think about that. How important is mindset? We talk about it all the time. Do you feel you're lucky or do you feel you're unlucky? Because if you feel that way, you're probably right. So I'd say push the meter over toward lucky, find the $20 bill, tell us about it, even better, give it away to someone else. Kind of fun, but thank you, Ryan. That was an awesome one. So isn't it interesting how our perception, our mindset can actually affect our daily life? That's one of the pieces as well. So what I want to do is share a lot of what occurred this last year. There's a couple different things, but most importantly, the perspective and the learning is really important for both you, your families, and your children as well. But this year, I'm going to make it real simple. There were a potential in the last 12 months for 3 mistakes. And this is the most important thing to take with us. I want to summarize the last year in 3 things. And they're 3 Ps. Not the PPP program, but let's flip that around. This is the PPP program. You could have had 3 massive potential mistakes. 1, panic. That's fear, right? 2, performance chasing. That's P number 2. Politics. That's number 3. So also, I added a 4th, which is pandemic. Those 4 items last year were cringeworthy items that could have caused you to actually have massive behavioral issues. But I want to praise you guys for not doing that. You follow your long-term plan, and that's fantastic. But when we look at this, what they all share, panic, performance chasing, politics, pandemic, what do they all share in common? Fear. It's a 4-letter word we don't like, but it is called fear. So it's interesting. I think most of the successful investors the past 12 months were those who were plan driven, well diversified, and had an equity portfolio. Since last February 19th was very interesting. Last February 19th was actually the peak of the market in 2020 until the fall. Right now, we'd be halfway through that drop of 34% in 33 days. So you start to look at these data and it's amazing. And those who are still holding their portfolio when the sun came up this morning are quite happy that they did. Remember the statements we made? Don't just do something, sit there. So anyway, that really rang true this last year as well. So I just want to start out with that kind of mindset and the story. I think those are two good pieces before we hopped into the markets. I'll let Zach talk. He's going to do something a little bit different, but I got some more perspective on the markets, if we will. But let me have Zach hop in as well. He's got a couple of great things he wants to cover.
Yeah, thank you, Chris. Really appreciate that. And normally we go into the markets, which is the investment planning side of things. But recently we had a couple of questions come up regarding Roth conversions. So we wanted to step over into the financial planning side of things. So I'm going to share my screen here with a Roth conversion calculator, and I'll show you two examples. For those of you on your phones where this is hard to see, I apologize. I will try to explain it as good as I can and quickly as I can, because we absolutely love this calculator and diving into the numbers and could spend hours just on one example. So I'll try to do it in 5 minutes for you guys. But the first example, we were recently introduced to one of our clients' children, which we really, really appreciate. And I have a passion with working with them as well. In this scenario, they're 40 years old. They actually make a little bit too much money to contribute directly to a Roth IRA. That limit is a modified adjusted gross income of $208,000 if they're married filing jointly, and if they're single, about $140,000. So what we often hear is that, oh, I make too much money, I can't contribute to a Roth IRA. That is certainly true, but there's a way that we can actually get around that, and it's by contributing to a traditional IRA, making a non-deductible contribution, and immediately converting it to a Roth. A lot of confusing terminology there, but what we want to show is just the benefit of being able to do that for a younger client that makes potentially too much money. One thing we have to be careful of is that if they have a traditional IRA balance already, then it's not as clean of a conversion. Then there's some taxes owed on it. But let's just say in this example that we recently went through, the client was able to put away a 2020 contribution of $6,000 and a 2021 contribution of $6,000 at the same time. Because they didn't have a traditional IRA balance, we're able to convert it immediately. And because it was a non-deductible contribution, it was just basis coming out, there's actually zero taxes owed on that conversion. So the question came up, what kind of benefit does this bring to them over the long term? And we took a look, and this calculator really shows it. So there's a lot of bars moving. I want you guys to focus on the right side column where it says $52,512. So just with the assumptions here, a lot of it to show the benefit is assumptions on both the growth rate and also when you take out of it and what the tax rates are at that time as well. But if we were saying that it grew at 7% for the entire time, tax bracket stayed at 30% all the way to and through retirement, and they started taking from the Roth dollars at the age of 75 and took them for 10 years, it'd be a $52,000 benefit to them for that one conversion, just one. Now, if we were able to do this for 10 years, we could potentially multiply this number by how many ever years that we do that. What's really interesting is that if we had a longer time period to live, and let's just say we didn't take from these Roth dollars until we were 85, we took them for 15 years till we were the right young age of 100 years old, that one conversion that we just made was $145,000 benefit, just one. So we absolutely love this, and this is where financial planning comes in. It makes such a big difference because with the investment side of things, as you guys have known, we can't control what the markets do. But this is a financial planning decision that we can control, and this is where we lean on a CPA to do so as well. One other example that I wanted to show that we recently came across is client 65 years old, conversion of $20,000. And we really have some key periods of time to make these conversions when you get into your 60s, and that's really between retirement date and 72 years old, when you have required minimum distributions. So let's just say, as an example, we made a $20,000 conversion from a traditional IRA to Roth. We have to pay taxes on that when we do so. And the biggest benefit we can get from a Roth conversion generally is paying from an outside source, from an outside savings account or something like that, so the taxes don't come out of the conversion. We just wanted to see the benefit that one of these conversions are to you. Same example, if we didn't change any of the inputs and we went back to starting distributions from the Roth at age 75 and took them for 10 years, this one conversion was a benefit of $4,000 extra in your pocket. Now, if we extended that out and we didn't take from our Roth until much later, it was almost an $18,000 and $18,241 benefit. What's really interesting, and this is where we could dive into the details even further, is that if tax rates were to go up when we take out of the Roth, it's now a $25,000 benefit. And that is just one conversion. And if we were able to work with your CPA and see that we could do 1, 2, 3, 4, 5 of those, could potentially be a massive benefit for you and your family. It's oftentimes, and you've heard Chris and our team say this, it's not necessarily what you make, it's what you keep. So that's really what we're trying to do here. There's a bunch more benefits to doing so just besides the dollar amount gained by taking distributions, like the passability and the inheritability to your heirs. And also there's no required minimum distributions on Roths as well. So without going into the details on those, we really wanted to answer the question that we've had a couple times is, what kind of benefit do we receive from one Roth conversion? So
part of what Zach's talking about here is it's really looking into family wealth distribution planning. So it may not make as much sense for your high earning kids to receive the money and eventually pay the taxes on it. It may make sense for you to do it and do it now. So as we're doing part of that, this kind of been a series. It's what we've been talking about in our bigger picture planning for you. So as we do that, we're considering these behind the scenes. We've got wonderful calculators. We don't always show you. We have more data than you ever want to see in your whole life. But what Zach is showing you here, he wanted to give you a great picture of actually what it is we do when we're looking at this. And that each one of you have set up for you in your own portal for the conversions. You can't use them, but it's all the calculators we can use and show you again in those scenarios. So we'll try to give you what's important, but sometimes it's opening up the curtain a bit that's important to see as well. So I appreciate that. That's awesome, Zach. Thank you very much. Did I cut you off? Was there another piece you want to talk about quick? Nope.
Nope, that was great.
Awesome, good. So hey, a couple of things as well. This year so far, low quality stocks have outperformed extremely well this year. Low quality stocks. So according to Credit Suisse, one of the best performing styles has been a basket of stocks with the highest probability of default. Think about that. It's up 18.354% per year or so far this year as of last Thursday. The stocks that are most likely to default. Now think about that. That's a super low quality rally. But that's what's doing well right now. So, and you're looking at rallies like that, that portion of the rally is probably not the one you want to look at. But for us looking at this year, small cap value is leading the way. It's up double what many of the other categories are. So right now, looking at markets, it's interesting to watch, but what hasn't performed well often does in the future. And that seems to be really operating now. A couple other things. There's a bunch of data that's come out, which we read. And we read them all the time. We don't always give it to you. But remarkably, and despite the crisis, corporate free cash flows reached new highs last year. Think about that. We shut the economy down and corporate free cash flows due to efficiencies reached new highs last year. It's absolutely amazing. Now, I want to give you something for you. Similarly, free cash flow picture for consumers also reached a record high. Your balance sheet is as good as it's probably ever been. And that's the case across all consumers when you look at them as an average. Now, if you lost a job or something, that may not be the case. But I think when you look at this, it really shows something about last year's kind of equity market resilience has been further aided by a stable system, a systematic backdrop with kind of underlying characteristics. So what's really cool about this is this has all been enhanced by your positivity, by some of the stimulus things, by the fact that we've been through this before. Now, it reminds me of two things. One, Warren Buffett's newsletter to his shareholders came out this week and this weekend. I heard it on Saturday and Sunday. One good thing, he was worried about retirees. That was a head article because he's worried about the fixed income most of them have because they a lot of times have 70, 80% fixed income. That's not our philosophy. But he says fixed income is going to provide you nothing, not even beating inflation on a go-forward basis. He's really concerned about it. But he also said, and it was another piece, You may think that there's things are going on in the U.S. politically or this or that is an issue. I'm going to make a statement, and he made this very clear. Never bet against America. There's never any precedent for doing so. And he made it evidently clear that also going forward, he doesn't believe that's going to be the case to bet against it. So there is some negativity out there, but it's interesting when you get the Oracle of Omaha, who really has nothing to lose or gain by it, gives us a few simple pieces of wisdom that we can all use as well. So those were a couple things I thought were important to share as well on that side of the wealth management. But Ken has a couple important pieces to share with us when it comes to the planning side as well, when it comes to taxable accounts and some of the questions you're asking. So Ken, why don't you give us what you've got?
Yeah, thank you very much, Chris. Appreciate it. I'm going to piggyback on what Zach is talking about, Roth conversion planning, what Peter mentioned in the beginning about qualified charitable distributions and 1099 tax forms. What does this all mean? A lot of it comes down to taxes and how our accounts are taxed. And what I wanted to do today is just go over a brief idea of really what it looks like to have a personal account that we talk about and how different accounts react with different sort of taxes here. So I'm just going to be drawing right now. Some say my 4-year-old Asher, who's in kindergarten right now, is a better drawer than I am, and you probably will get the feeling for that right now. But when I start to draw this out, I look at the different buckets. We look at our Roth bucket that we potentially have. This could be our IRAs. This could be our 401k if we have a Roth 401k portion to it. Then you take a look at our traditional IRAs here. I'll call this traditional. And again, this could be our IRA as well. This could also be our 401k as well. So then you have this third bucket, which sometimes brings up questions about how does that third bucket work? And what it's called a personal account. And it's a non-IRA based account, okay? So it gets taxed differently, has different age limits, different contribution limits. There are no limits in personal accounts like there are in Roth and traditional IRAs. But here's really how it works. And some of these personal accounts over here, you've seen them named as TOD, you've named them as trust accounts based on the estate planning you've done. Now, when you have monies in these accounts, and we're heading for retirement and we're looking for the distribution of how do we get a paycheck out of our accounts, these are the things that we're looking at for you. Now, when you look at your Roth IRA, if you've met the requirements of the holding periods, money that comes out of there in retirement is no tax. It's not taxed at all, okay? Now, money coming out of your traditional IRAs is all taxed, okay? Now, money coming out of the personal accounts here actually is, I'll call it some taxed, okay? Now, why is that important? Because when we look at all this and we look at retirement income for you in retirement, what we're trying to do is we're trying to do something called tax bracket management, okay? So pulling some money from different accounts will help us get the income we want, but maybe pay less in taxes over time. So that's that piece there. Now, when I look at this, I'm just gonna get rid of that one. I'm going to focus on this personal account because I've had some questions on this one, and I want to make sure that we're clear on what this personal account is. It's a wonderful investment account. It's a very flexible account. You can put as much money into it as you want. You can take as much money out of it as you want at any point in time. There's no age requirements at all. But when you put money in here, 3 things are going to happen. You're going to earn interest on this. You're going to earn dividends, and you're going to have capital gains as well. Okay. Now, why is this important? Because it's tax time right now. And some of you have actually missed this one where this account actually, because of these, this non-IRA account, it generates a tax form, and that's called a 1099 tax form, okay? So you should have gotten them by now, or they're coming to you. These are really important to get to your tax accountant. Okay, if you have a personal account, a non-IRA account that you've already paid taxes on, and you put money into this account, you're going to generate a tax form every single year from what's called a 1099. Okay, now how do these work? One of the biggest misconceptions that I've heard so far, and where we get tripped up a little bit, is if we have this personal account, okay, and let's say we put $50,000 into this account. I'm going to give you a very simple example here. The $50,000 is what we call after tax. You've already paid taxes on the $50,000 that you put into this account, okay? We call this principal. And you've also seen a word that we've used before called basis. You might have heard us talking about step up in basis or cost basis. That's what we're talking about. It's your own money that you put into these investments over time. Now, let's just say we invest in Fund A and it goes up $10,000. Now we have $60,000 in our account, and you say, hey, Ken, I need money for whatever the case may be. Send me all the money in there. You don't pay any taxes on the money you originally put in, but you will pay capital gains rates on the money you've made in your investments. And some of these, if you hold them for a year or longer, are going to be taxed at 0%, going to be taxed at 15%, or even 20%. Okay, that all depends on your other income and what you have based on your tax return. So I just wanted to clear that up. There's also gains and losses that we can offset in these accounts. That gets a little too technical for the time we have today. But if you do have questions on your personal account and how the taxes work, by all means, reach out to us. We'll be happy to walk you through it. Just know that your money you put in, not taxable on the way out, but the gains that we make are subject to either short-term capital gains or long-term capital gains. With that being said, I will hand it back over to Chris.
Oh, outstanding, Ken. Thank you very much. You know, you were speaking of buckets earlier, and it reminds me of something as well. I saw a sign that said "Lost." Buckets of sand, silt, and gravel. Very high sedimental value. Anyway, it just reminded me of something. My mind works in a little different way, but I always like to bring some humor into it as well. But what I'd like to do here is give some perspective. And again, thank you for some of those great technical pieces and how we should look at different monies. Both you and Zach did a phenomenal job on that. But what I'd like to do today is kind of end with a little bit of called ending gratitude. So I want to end in gratitude, and I want to thank you tremendously for your introductions. We had a wonderful, wonderful year. We really love getting to know the people that you have introduced to us. And I want to say, since the year and the pandemic really overwhelmed the economy last year and the markets since February, we've had the occasion to really revisit that long-term plan of wisdom of staying the course and really continue to act on the plan rather than reacting to the market. So you all know that. You've been fantastic at it. You know, we've had very, very few mistakes. There's a few weaknesses from time to time. You all feel them. But for the most part, nobody really acted on those, and that was phenomenal. We mustn't doubt that we'll get more. We're going to get more opportunities. It's not always going to be so dramatic as a pandemic. Politics, again, I told you the 4 different P's that we have. It's the PPPP program last year, and you guys passed with flying grades, which is outstanding. But, you know, what's interesting is that successful investing remains very simple. And for us, it's being goal-focused and sticking to a plan. But it's not easy. Notice the difference. It's simple, but not easy. Remember last year, according to a study done, I think it was by maybe it was Fidelity. It was Fidelity. A third of people over 65 during the correction sold all their stocks at some point. Congratulations to you of our clients that didn't. I think that's really interesting. But really today I want to say this because you may have a friend, relative, or a colleague who didn't have that same experience during the pandemic or during the recession or the bitterly contested election, and may have benefited from this kind of advice. So what we're looking at here, we really appreciate what you've done in the past by introducing those people. But if you have somebody who's considering retirement or maybe didn't have that experience that you would like, we love working with you. We like to work with other people like yourself with the same mindset. And we think that that's important. So if it's the case, we certainly appreciate your introducing us. We really do appreciate that. We treat them with utmost kindness and respect. We reach out to them. But what we don't do with them is equally important. We don't hound them. We don't follow up. If they simply want to ask a question about retirement and that's where it ends, that's where it ends. I think many of you who have done that before know that, but I think it's worth saying as well. So if you're looking to find somebody who's looking at the same level of planning, the same mindset, really what we call our success track in our Gentian retirement, which is plan it, live it, and give it. We would love, we thank you tremendously for the introductions you have and will provide to us. But I just thought I would bring that up because really wrapping up this last year as it's been just past that mark of this correction, it's an interesting piece I just wanted to bring up and thank you for, because you make what we do special. Our marketing plan is to let you introduce us to people, and we'll spend all of our time on you. So it's an integral, relationship that really works well together. And you guys have done a phenomenal part of it. So when you see the awards and the growth, that's why we award you that. That's why we look at that as, hey, listen, the awards are interesting, but to you is where they go. So thank you tremendously for that piece as well. And thank you most and always mostly for being our clients. We are grateful for that. And we look forward to seeing you soon. And remember with us here at Gentian, it's Gentian Retirement. We're really helping you plan it, live it, and then give it. So thank you here on behalf of the team at Gentian. And until 2 weeks from now, please be safe, stay positive, and be grateful. Thank you.